Bloomberg Audio Studios. Podcasts, radio, news.
Governor, thank you so much for speaking to Bloomberg.
Welcome.
Now, you've been quite direct in suggesting that the BOE may cut rates more sharply than the markets are expecting. Is that because you're worried that markets won't be prepared for what's to come?
No, I think our forecasts are conditional on a number of things, but one of the things that obviously are conditional on is we use the market curve to set them up. So I think it's important that if we find that a forecast with the market curve produces a best judgment, which has inflation below target or above target, wherever, but not at target at the sort of horizon, we say so. We say this is where we got to. Best collective judgment is that. Now, it follows, I think, that, and this is the comment I made earlier, that what we're saying is if, and the if is of course critical here, if the world evolves as that forecast suggests it was, well, probably the case would be there for a less restrictive path of policy.
So is
it's
June
all conditional?
Everything is conditional. Is June a live meeting?
All meetings are live.
So is June likely?
That's a different question. That's different. Look, I think the key points I would make is that we have changed our view on the likely persistence of inflation, on the second round effects. And I think it's good news. We think there's evidence there to suggest they will be less pronounced than we thought they would be. But that's a judgment. And for me, I'm now looking at particularly these three key indicators: services inflation, pay, and the quantity side of the labour market, to really judge this persistence question, how it will evolve.
But Governor, because you were quite upfront about market expectations, does that come from Ben Bernanke's review, that you will talk more about the markets to indicate more to the markets also what you're doing next?
Well, we're not going to implement the Bernanke review piecemeal. So we're obviously going to spend a few months really sort of thinking quite hard about what we do. And he raised the conditioning assumptions as a point, actually, and this question which I think all central banks wrestle with in various ways, which is how do you actually sort of represent a future profile of rates to set up your judgment without sort of getting yourself into a position where you're absolutely nailed on, as it were, for a view of rates 2 years out, which of course is just not realistic to commit to.
But can we expect more market commentary from you going forward?
Well, I think we're in a particular situation at the moment. I've said before, it's a high bar, I think, for us to sort of come out and comment extensively. But I think the point we've made today, and I think have to make, is look, quite a lot of them, when we do the analysis, quite a lot of the market movement of late appears to have been US, in a sense, originated. Now, there's always some of that, of course, but there seems to be more of it. And yet, our analysis would be that inflation dynamics here are different to the inflation dynamics in the US. We're in a very different sort of situation in terms of our economies. So there's a tension in there, and I think that's the point we have to point out.
But this is basically because the Fed maybe overpromised the cuts in December and then couldn't deliver in terms of 2%.
Well, I'm not criticizing the Fed in any sense or judging the Fed. I think the US economy has evolved. I mean, that's the fact. I mean, that's how it's evolved. So I think the way it's evolved has been, if anything, to sort of put in a slightly starker relief the difference of inflation dynamics.
Governor, are you worried about the second round effects of a cheaper pound?
Well, I mean, the exchange rate hasn't moved sharply, frankly. It's moved a bit, and of course you'd expect that because it's a relative price. So this point I make about different inflation dynamics, you'd expect some, but it hasn't moved sharply. So no, I'm not. We watch it very carefully, but it's not something that. And by the way, as we said, as we always do, in setting up our commentary on the conditioning assumptions this time, actually the exchange rate hasn't moved that much.
Governor, there is an assumption, looking at history, that once you cut, you continue cutting. Now, without prejudging what you'll do, can you give us an idea of how you see the cycle different to 2009?
One thing I would say about this, which is sort of quite interesting, and it's something that we looked at during this round, it's quite interesting in the history of the MPC that most of the cutting cycles in inverted commas, have actually been prompted by some sort of shock or other, rather than being what I might call a natural cyclical sort of, we've reached the top and now we go down the restrictiveness curve. So we don't have a lot of, I would just caution, there isn't a lot of sort of history really to.
So what you're telling us is because you're not cutting in a recession, it could actually be one and done?
Well, I think that would be unusual, but I would say, as I said earlier, nothing's settled. There are no fait accomplis. Nothing's ruled out.
Governor, what can you tell us about the play between, of course, interest rates and QT? Right. Some may find it confusion because they're pulling in different directions.
So the message we've always given with QT is that QT operates in the background for us. We don't think it has large impacts in terms of markets. But the other point, and this is really the critical point, when we sit down to decide on what the right interest rate setting is, we take into consideration everything, including markets, obviously, and markets will have absorbed, if you like, and taken into account the impact of QT. So, in other words, QT is always there, if you like. If there is any effect from QT, we'll capture it because we'll capture it in the movement of markets, and then we will set bank rate to reflect that.
But you don't think it's confusing for markets? This kind of
I don't think so, no. Don't think so.
So you're not expecting it to end it before the end of the year to make sure that there's no confusion in what you're trying to do with the economy?
I don't think there is, to my mind, any difficulty if we get to the point when we're going to cut interest rates to have QT going on as well.